All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer, nothing in this podcast or any of our other materials should be taken as investment advice. James or I could hold positions in any of the stocks that we might mention in this podcast, and we could change our positions at any time, with or without notice. So make sure to do your own work and consult a professional before making any investment decision. So with that being said, the topic of today's video is going to be EV charging stations. So just as a brief background on EV charging businesses, perhaps surprisingly, EV charging is not a good business at all. And there's a few different aspects to this. The first is that gross profits of EV charging is very low. And a big part of that is because of the structurally low throughput of charging stations. The selling, general, and administrative costs are surprisingly high, mostly due to maintenance and administrative complexity of charging stations. And finally, the depreciation expenses are very high as well, due to the low lifespan of charging stations themselves. So to the first point, the gross profits, the main reason that gross profits of EV charging companies is low is because throughput of charging stations is very low. If you think about it, it takes anywhere from 20 to 40 minutes to fully charge an EV, which puts a cap on the maximum number of EVs that any one charging station could charge over the course of any given day. The second reason is that utilization is still very low. Only about 1% of all cars in the US are currently EVs. And even of those 1%, a lot of times people will charge at home and not even go to a charging station. And finally, uneven demand. There's going to be peaks and valleys. Like during maybe 5 p.m. to 7 p.m. after people are coming home from work, or at the peak of vacation times throughout the year. So there's going to be very uneven demand that's going to decrease utilization even further. And finally, charges are relatively cheap. So these charging stations, they have to compete with people who just charge at home, and electrically charge. The cost of electricity for charging at home is very, very cheap. So there's a cap on how much these charging stations will ever be able to charge per electric charge. So the second reason that EV charging is a bad business is that there are surprisingly high operating costs. So setting up and operating charging stations is incredibly complex. Getting the right permitting for building a charging station can be very complex in many jurisdictions. Additionally, you have to worry about having very, very high power connectivity to power these EV charging stations. And then finally, maintenance is a challenge for charging stations. A lot of charging stations are very, very frequently out of order in some way or another. And so being able to send people to fix those charging stations, in some cases in very remote locations, is a huge expense. And then finally, charging stations are depreciated over a course of only about 5 years, give or take a couple of years. And that's due to the wear and tear on the very, very, very high power electronics of the charging stations, in addition to theft and vandalism of the charging stations. So all of these costs and unfavorable financials lead to very, very poor profitability of charging companies. So ChargePoint and EVgo are the two main US-based charging network companies. In the most recent quarter, in Q2 of 2024, ChargePoint made a little over $100 million in revenue. EVgo made about $60 million. After their costs of goods sold, their gross profits were much lower than that, only about 25 million and like 5 million for ChargePoint and EVgo respectively. And then you have to subtract very, very large selling, general, administrative, and also R&D costs that so they end up with very, very significant net losses for the quarter. So with that, I'll hand it over to you, James, to talk a little bit more about the specifics of ChargePoint and EVgo's financials.
Yeah, so before we get into that, just a quick reminder about our website, differentiatedanalytics.com. This is a website where we provide premium, professional-grade short selling research, where we identify companies that we believe to be either fraudulent or overvalued. And then we write very detailed, professional grade short selling reports, which are available to premium subscribers on our website. So if that at all sounds interesting to you, make sure to check out differentiatedanalytics.com. The link is in the description below. So now back to ChargePoint and EVgo. So here I have the stock price performance of the two companies, and you can see over the past 5 years, both stocks have performed horribly. ChargePoint has declined by 87%, while EVgo has declined by 60%. And that's because both of them are losing money. And as Ryan explained, there are some very unfavorable dynamics around the EV charging industry. And as people have realized that, these stocks have done very poorly over the past 5 years. But interestingly, if we zoom into the past 1 year, we see that EVgo in particular has actually made a comeback and has actually increased in value over the past year. So we'll take a deeper dive into these two companies one at a time, and we will start with ChargePoint. So ChargePoint is a little different because they do not actually operate the EV charging stations. Instead, what they do is they design and build the infrastructure, the physical actual chargers, which they sell to independent operators who operate the charging stations. So the way it works is, say you're an independent operator, you have some retail store or whatever where you want to place EV chargers in your parking lot to try to make a little bit of extra revenue. You would buy the charging stall from ChargePoint, and then you would sign up to a monthly subscription to get activated onto ChargePoint's software. And then ChargePoint also offers maintenance services to maintain the EV stall, the charging stalls. If we look at the financial performance, as Ryan was alluding to previously, ChargePoint is losing a lot of money. Their revenue was increasing up until 2023, and then it peaked around the beginning of 2023, and then revenue has actually been declining since then. They make a very modest gross profit, but this has not been enough to cover their corporate overhead, and ChargePoint has reported massive operating losses throughout its history. The decrease in ChargePoint's revenue likely points to the fact that their customers, the people who actually operate the charging stations, are struggling with profitability. Because if everything was going well for the customers, then they would be buying more charging stalls. But the fact that they're buying less charging stalls probably means that the end customers, the actual operators of the charging stations, are not doing very well. And that brings us to EVgo. And EVgo is an actual operator of charging stalls. So unlike ChargePoint, which sells the hardware and maintenance, EVgo actually buys the charging hardware and operates thousands of charging stations across the country. So EVgo will, by analyzing EVgo's financials, this will give us a pretty good idea of the economics of charging. Historically, EVgo's revenue has been increasing quite well. So in the most recent quarter, they made a little over $60 million of revenue, and that was an increase of 32% versus the prior year. So their revenue is indeed increasing very rapidly, but their gross profits are very, very thin, very, very small gross profits, and their operating losses are massive. So we need to answer the questions of, how is EVgo's revenue growing so fast? And why is it that despite this revenue growth, they're still losing a lot of money? Well, the first question is relatively simple to answer. The reason why EVgo's revenue has been increasing is because they've been opening up a massive number of new charging stalls across the country. So this chart shows, back in the first quarter of 2022, they operated about 1,700 charging stalls. By the second quarter of 2024, so 2.5 years later, they have almost 3,500 charging stalls. So they've basically doubled their number of charging stalls over the past 2.5 years. In addition to increasing their number of charging stalls, they have also made great efforts to increase the reliability of their charging stalls. So historically, one of the biggest problems with public EV charging is that a lot of times the operators of the charging stations will be neglectful and will not do enough maintenance, such that at any given time a significant portion of the charging stalls are out of order. And this can cause, this is a headache for customers, obviously, because you have your EV and you drive into the charging station, then it turns out that maybe the charging stall doesn't even work because it's out of order. And it's also bad for the company because obviously if the charging stall is out of order, it's not generating any revenue. So in the beginning of 2023, EVgo started a new initiative, which they called their Renew program, where they would invest many, many millions of dollars to increase their maintenance capability, hire more maintenance employees across the country so that they'll be able to monitor all of their thousands of charging stalls. And when one of them is out of order, they can send somebody there to fix it very quickly. So this has been their whole goal, is they're saying, okay, we're willing to spend money on maintenance to increase the reliability. And this Renew program that EVgo did, it seems like it has indeed accomplished its objective. Because according to the company, in 2021, their utilization rate was only 6%. That means that, throughout the day, if you were to go to a random EVgo charging station and look at a stall, 6% of the time it'll actually be charging a vehicle. And then the other 94% of the time it will be idle, either because there's just no customer there or because it's out of order. By the end of 2023, this utilization rate had increased to 19%. So this is indeed a massive increase in utilization. And if we look at the revenue that they generate per charging stall, this has similarly increased massively because obviously as it's being utilized more, it's generating more revenue. In the first quarter of 2022, they generated less than $5,000 per charging stall. By the second quarter of 2024, they've generated almost $20,000 per charging stall. So a 4 times increase in the revenue generated per stall. So that all looks very good. But on the flip side, this came at a cost. So because they did this Renew program, they hired all these new maintenance people to increase their maintenance capabilities. Well, that costs money. And we can see that as, over the past couple of years, even as the revenue that they generate per charging stall has increased, so too has their costs per stall. So what I have here, what I call cash cost per stall, this is just, basically the cost of goods sold, excluding depreciation, because we'll look at depreciation separately. But so basically, this is the cost of revenue, excluding depreciation, divided by the number of stalls. And that's what I call the cash cost per stall. So as revenue per stall has been increasing, so too has the cash cost per stall. Part of that is just, there's EVgo is incurring greater electricity cost because they're doing more charging, but also they're incurring greater cost insofar as the maintenance. And so that's the trade-off. They are generating more revenue, but then they spend more on maintenance. And see, as a percentage of revenue, their cost of goods sold, it has been, roughly stable at 70-ish% of revenue. And that's excluding depreciation. And then if we take the revenue minus the cash cost of goods sold per stall, we get the cash gross profit per charging stall. So this kind of gives us a look at the unit economics of EVgo. And as they have, done the Renew program and increased the reliability and utilization, their cash gross profit per stall has indeed increased. So back at the beginning of 2022, they were only making like $1,700 of gross profit per stall. And by the second quarter of 2024, they're generating more than $5,000 per stall, which is, obviously a huge improvement. But is $5,000 per stall of gross profit, is that enough for EVgo to be, a sustainably profitable as a business? Well, when comparing, when looking at the gross profit that you generate from each stall, we also have to compare that to how much it costs them to build the stall to see if they're getting a favorable return on investment. So, one way that we can estimate their capital costs is that we can see that between the first quarter of 2022 and the second quarter of 2024, EVgo spent $404 million on capital expenditures and built about 1,700 new stalls. So if we divide those two numbers, we get that they spent $240,000 of capex for each stall that they built. Now, not all of that $240,000 is for the actual charger itself. There's also, in some cases, they purchased the land that the stalls are placed in, and also there's other equipment and other stuff that they had to buy. So not all of that, this $240,000, not all of that is just the charger itself, but it's just everything that they had to, all of the capital expenditures that they had to make to set up everything and make these stalls operational. But if we divide this, so they're currently making about $5,000 of gross profit per quarter. So multiply that by 4. They're currently making about $20,000 of gross profit per stall per year. If we compare that to the $240,000 of capital expenditures, that's a 12-year payback period. And that 12-year payback period is not very good because, as Ryan explained earlier, the charging stalls depreciate very quickly. Especially if the utilization is high, the electronic components are going to wear out. There's just going to be normal wear and tear. The people can, sometimes there's theft and vandalism where people will try to steal the copper wires and stuff like that. So the EVgo, they depreciate their charging hardware based on an estimated useful life of between 3 and 7 years. And, compare that to the 12-year payback period, that's not very good at all because it wouldn't even pay for itself in 3 to 7 years. Now, with that being said, the $240,000 that we were talking about earlier, that includes land and some other stuff that doesn't depreciate as quickly. But the point I'm trying to make is that given that the charging hardware itself depreciates very quickly, you would want to see, ideally, a very fast payback period. But based on EVgo's numbers currently, it looks like they have a very long payback period, which does not look good in the long term. Also, here, we're only looking at the gross profit. We are not considering the corporate overhead. And as we'll see shortly, the gross profit that they currently generate from their charging stalls is not enough to cover their general and administrative expenses. So they are, incurring operating losses. And they are providing, in their most recent investor presentation, they provided guidance saying, they're basically bragging about the fact like, hey, look, back in 2021, we had a adjusted EBITDA margin of negative 231%. And this has increased, and this has improved to a adjusted EBITDA margin of negative 37% in 2023. And then they say that in 2024, it's going to get even better. And the adjusted EBITDA margin is going to be negative 15%, according to their 2024 guidance. But one thing, we have to consider is that adjusted EBITDA does not include the cost of depreciation. And the cost of depreciation is very significant because this is a very capital intensive business, and the charging equipment will need to be replaced eventually. And that's going to be a massive cost when you have to, when your charging hardware fails and you need to replace it. That's extremely expensive, and that's something you need to consider. Adjusted EBITDA does not consider that. So the fact that this is an extremely capital intensive, basically infrastructure company with huge depreciation, yet their adjusted EBITDA is even negative. That's a very bad situation to be in, because you would want the adjusted EBITDA to be very positive because you have to use that EBITDA to pay for your capital expenditures, right? So, but the fact that they're even making negative EBITDA, that's basically showing that they're currently nowhere close to profitability. Another way to look at it is over the past 2.5 years, EVgo has generated cumulatively negative $500 million of negative free cash flow. So over the past 2.5 years, EVgo has burned about $500 million. Despite all of this money and all of this investment, they are still yet to generate positive EBITDA. So, investors have given a lot of patience to this company, but, especially, I go again to the point that when you have an infrastructure company, you spend massive capital expenditures up front, then you expect to generate EBITDA to basically make a favorable return on investment. But with EVgo, because of all the challenges in the EV charging industry that we talked about earlier, despite having spent $500 million on capital expenditures and cash flow from operations, despite having burned $500 million, they still are not even generating positive EBITDA. So basically, I don't really see how, if there is a path to profitability for companies like EVgo, it's probably many years in the future. So I think that about wraps it up for everything we had to talk about ChargePoint and EVgo today. So as always, if you have any thoughts or opinions about EV charging, let us know in the comments section below, and we will see you all on next week's video.